So you're thinking about making that big leap, right? Maybe upgrading from your HDB or buying your very first private condo. It's exciting, but let's be real. It can also feel a little overwhelming. That's exactly why we're here today, to break it all down into a simple step-by-step guide. To make sure we're getting this right, we're tapping into the expertise of professional realtor Karen Xiao. If you're looking for personalized advice, her number is 96530-527, and we'll mention it again later.
And this is the question on everyone's mind, isn't it? Is this going to be your dream home, or are you walking into a financial labyrinth? You see, a condo is a huge lifestyle upgrade, for sure, but it comes with a whole new set of rules and financial details. So how do we make sure you end up with the dream and not the maze? Well, it all starts with understanding what you actually own.
Okay, first up, let's get one thing straight. Moving into a condo isn't just about the fancy pool and gym. It's a totally different way of thinking about ownership. You're not just buying your four walls, you're basically buying into a community that you and your neighbors have to run yourselves.
All right, let's talk jargon for a second. The legal term for your apartment is a strata lot. Simple enough? But here's the really important part. The size of your unit determines something called your share value. Just think of it like this. The bigger your apartment, the bigger your slice of the pie in the whole condo development. And that slice determines how much you pay in fees and how powerful your vote is when big decisions need to be made.
So here's where it's totally different from living in an HDB. Inside your front door, that's all you, your strata lot. But everything else, the pool, the gym, the gardens, the car park, that's common property. You co-own it with every other resident. And that means you're all responsible for keeping it in great shape.
Which means your role completely changes. You're not just a resident anymore, you're a co-owner. You're part of what's called the Management Corporation, or MC for short. That's a fancy way of saying you and your neighbors are the bosses. You have to show up for meetings, vote on stuff, and this is a big one, pay your maintenance fees on time. Because when the lobby needs a paint job or the lift breaks, everyone has to chip in to fix it.
Okay, we've covered the lifestyle part. Now let's talk money. Because beyond those monthly fees, there are some pretty big taxes you need to know about. And trust me, you want to get this part right from the get-go.
So, your annual property tax, it all boils down to one simple question. Are you actually living there, or are you renting it out to someone else? As you can see, the difference is huge. If it's your own home, your owner-occupied property, you pay a way, way lower rate. The government really wants to reward people for buying a home to live in.
Now, if you're an investor, listen up. This number is a big deal. For a rental property, that tax rate can shoot all the way up to 36% of its annual value, which is basically the estimated yearly rent. That can take a huge bite out of your profit, so you absolutely have to bake that into your sums.
And then we have the big one, the additional buyer's stamp duty, or ABSD. Now look at this table. If you're a Singapore citizen buying your very first home, great news, it's 0%. But the moment you go for a second property, bam, you're hit with a 20% tax. And for PRs and foreigners, the numbers are even higher right from the start. You've got to know where you stand on this chart before you do anything else.
All right, enough theory. Let's get our hands dirty and look at a real-life example. We're going to dive into a new launch condo called the Sen. This is exactly the kind of analysis a pro real estate agent like Karen Xiao would do to see if a project is really worth it. You know, doing this level of homework is what separates a good buy from a bad one. And if you're thinking about this stuff, you can always reach out to her at 96530-527.
So, what's the story with the Sen? Well, it's a 99-year leasehold right in the heart of Upper Bukit Timah, a really popular spot. The developer is Sustained Land. Its big selling points? You're super close to the Bukit Timah Nature Reserve, and you've got the whole future beauty world transformation with its new transport hub coming up. It's really aimed at families and investors who already know and love that area. But hang on, this is the number that got everyone talking. $841. That's the land price the developer paid per square foot. Let me put that into perspective for you. That's a price you'd expect to see back in 2017, not today. This is unusually low, and it means the developer has a ton of room to play with when it comes to the final selling price.
So, you're probably thinking, wow, low land price. This has got to be a guaranteed win, right? It feels like a total slam dunk. But here's the thing. Is it really that simple? Let's not jump to conclusions just yet. Let's do a proper deep dive. We're going to look at the good, the bad, and the ugly of investing in the Sen. Every smart buyer looks at both sides of the coin. So let's flip it over. Okay, on the pro side,
The argument is pretty simple. It's all about that potential to get in at a fantastic price, maybe even close to what older condos nearby are going for. Plus, you have that whole URA master plan for Beauty World, which could boost prices down the road. But the risks are definitely there. For one, the area is packed with other condos, so there's a ton of competition. Rental returns here are not great, usually under 3%. And, a big one for families, it's not within that magic 1-kilometer zone of the super popular Peiwa Presbyterian Primary School. And really, this quote from a recent review just nails it. It says, the whole investment case for the Sen comes down to one thing, the price. If the developer gets greedy and prices it too high, way above the nearby resale condos, well, the project loses its biggest superpower, and the whole reason to buy kind of disappears.
So, if you were looking at a project like this, how should you play it? Well, here's a simple, practical checklist you can use. We call it the double safe approach, and it's all about protecting your investment.
First, you need price safety. This means you only pull the trigger if the entry price is super close to the resale prices of similar condos around it. Second, unit safety. Don't get tempted by the flashy penthouse with the amazing view. Go for a solid, mid-level unit instead. It gives you a much bigger pool of potential buyers when you eventually sell. And third, strategy safety. Think about a hybrid plan. Maybe you live in it yourself for a few years. That gives you breathing room to wait for the market to grow without the stress of finding a tenant right away.
So at the end of the day, buying a property is always this dance, isn't it? A balance between your heart, finding a home you love, and your head, making a smart financial move. Now that you have this framework, the big question is, how will you find that perfect balance? Of course, every person's situation is unique, so if you're looking for guidance that's tailored just for you, speaking with an expert can make all the difference. You can get in touch with Karen Show at 9653-0527. Thanks for tuning in.